Hello world, welcome to the Pocketgamer.biz Podcast. I'm one of your hosts, Peggy Anne Salz, and I have Craig Chapple. Craig, it's so good to have you because you're usually over at Week in Mobile Games, and here you are here.
Yeah, I'm very excited to be on the interview version, I guess, of the podcast. It's about time.
And we have you here, so I'm going to take advantage of the opportunity. You know, Week in Mobile Games, it is about hot trends, hot topics. Only the beginning of the week, but what is high on your radar right now?
Yeah, I guess for anyone that hasn't listened to that one yet, it's the editorial team. We get together, talk about the week's news, and attempt to provide some analysis. Or look silly doing so. But this week, it's quite early to think what the big news of the week is. There's been some interesting sort of data around Pokemon trading card game Pocket. Uh, Doing very well, a couple 100 million potentially gross revenue according to AppMagic. Dungeon Fighter, well, only App Store in China, but $1 billion revenue, which probably means a few billion maybe for a third-party address store. So a few things to talk about. Also, might rant about Google, but that's
Isn't that every week?
yeah. Not just what it does to the app stores, what it does to search and in general.
Another hot topic is, of course, the one we're going to be looking at because, first of all, we're near the end of the year. So we look ahead to the future and the trends shaping the mobile gaming industry. And of course, that very exciting, explosive, dynamic landscape of gaming investments and M&A. And you see it yourself, Craig. You know, it's either like it's in the billions or it's further on down and what's happening in that magical middle. So we have someone who's going to tell us what he thinks about the industry and give us, I think, a good glimpse into the trends because he does this, right? Our guest is Michael Metzger. He's managing partner at Drakestar, which is a global media and tech investment bank. So this is his day job. This is the real deal. And he does it because he's advised over 20 gaming M&A deals in the last few years. That includes the sale of Spike Trap to Reddit, Ector Games to Zynga, Singularity 6 to EG7. I could go on. It is a who's who of the industry, but we've got a who's who of the industry as well because we've got you, Michael. Welcome to the show.
Thank you so much. Excited to be here.
Great to have you, Michael. And before we get into the data, because that's where we all want to go, but everyone's more than a title. And to kick things off, you have been really involved in the industry. So that means you have memorable experiences from the early days in M&A, as well as what you're seeing right now. What continues to influence your approach today? Because the gaming industry is evolving. How has your own approach to gaming M&A evolved?
One item which I think is very crucial on every deal is timing towards close. So time is kind of the enemy of M&A, and any time like a client signs a term sheet with a goal to close, we're always pushing to get to that point as quickly as possible, and in many cases in less than 30 days. It's There's all kind of scenarios. One interesting case was actually last year where we worked with a company called Tasty Pill. They had a large portfolio of hyper casual games. We in the end sold them to Azure, and the deal was kind of done. All the documents were done. We had finalized kind of the announcements, and that's when Unity announced a UA fee. And that fundamentally changed the business of both Azure and Tasty Pill. And, we thought, gosh, if we had just closed a day earlier, this deal would be done. And so it was put everything in limbo for a while. In the end, Unity withdrew the UA fee and the deal closed. Everybody was happy. But that was just one of the fairly extreme examples where everybody was saying, gosh, if it had been like just 1 or 2 days faster, this would be all behind us. And as you started off with one of the earlier deals, one of the earlier deals I worked on was a merger of UGO, which is part of the Hearst Corporation, with IGN, which at the time was part of News Corp. That was maybe 2010 or 2011, that time frame. And that was one of the examples where we were able, mainly due to pressure and a high-level agreement between Hearst and News Corp, that this deal would need to close very fast. And there was one of the example where time from signing a term sheet to closing the transaction happened in less than a week. So if all parties are motivated to make it happen, and it was obviously very stressful for all parties involved, but it is easy, not easy, it is possible to close some of those deals fairly quickly.
You sign as quick as possible, which kind of a week kind of sounds mad. But what happens before, like, signing the term sheet to actually finishing the deal? Like, how long is that process? Maybe it's like a piece of string, but so like someone's interested in acquiring another company, and then like how long does the whole process take generally?
It all depends on the situation. So we typically say from the time we're engaged to close, anywhere between 4 to 6 months. That's kind of a good ballpark number. And that assumes that there are parties interested in the end, so getting towards a close, towards the 6 months range. And it doesn't necessarily assume there are any external pressures to get it done fast. So it's typically, several weeks in preparation, and typically spending a little bit more time on preparation. Preparation meaning just working with a company on the story, the positioning, doing a PowerPoint, a management presentation, doing the financials, historical financials and projections. That typically takes about, normally 3-4 weeks. Can be done much faster, but it's normally also worth spending some time on that, and then reaching out to the different buyers, and then buyers typically then at some point sign NDAs, and then their management presentations, and then different buyers make, there's a lot of back and forth, and then at some point we ask buyers to make offers. They provide offers, and then there's a lot of negotiations there. And also in the spirit of getting to a close quickly or quicker after we sign a term sheet, we typically put in a lot of additional terms in the term sheets where both the seller and the buyer agree on those early on. That's kind of, has to do with some of the reps and warranties, and is there any escrow, and if so, how much, and a lot of items which, from a seller's point of view, it's good to agree on when you still have the options to go with multiple buyers. And it also really helps having reached agreement on those terms before signing exclusivity. It just makes things a little bit easier getting towards a close too.
And then after 6 months, external factors could completely shake it all up potentially.
Yeah.
Absolutely. That's why time is the enemy. We had deals. I mean, the Unity announcement was kind of extreme, as it kind of one morning just put everything off. But there had been situations where buyer had a not so good quarter and the stock drops 40%, and it says, look, we can't proceed, or it's a lot of unknown, and let's want to try to get to the finish point as quickly as possible.
Well, it looks like a number of deals are getting to the finish point because, and you've seen it too, Craig, we've been writing about this forever, and there was the winter. It was always, there was this, and here we are in winter. So it makes me think about it, it's going to be hard. It's going to be difficult. But then we're looking at your Q3 global gaming report, and it's saying, okay, 70% year over year increase in M&A sales, totaling $2.5 billion in disclosed value. And we always hear about consolidation in the industry. So yes, that would make sense. That all comes together. But from your perspective and from this report, what is it that's driving the gaming M&A?
First, I would say it has been a slow and gradual improvement. So, which I think is good. It's been a fourth quarter of a steady increase of number of deals. And when we look at it, we look a little bit more number of deals than absolute deal value. Deal value obviously matters a lot too, and I'll talk about that in a second. But deal value is often only disclosed for the very big deals, and the smaller, medium size often don't have one disclosed. Just number of deals were like at 33 in Q3 last year, and Q3 this year we ended up at 56. So that's kind of the increase, steady increase. And drivers are more buyers, more strategic companies are slowly getting back into exploring M&A deals, making offers after just pausing for an extended period of time. So that's, I think, one driver. And Playtika's deal of Superplay is one great example at the last quarter at the great valuation. Second driver is probably valuations are generally fairly attractive, and PE firms are now very engaged. Historically, PE firms were not very active in the gaming sector, but the two largest deals of the year were the acquisition of Jagex by CVC and Keywords by EQT, two PE deals. And if you look at the dollar value year to date, those are the two biggest ones. So that's definitely a key driver. If you look what happened this quarter so far, it's also kind of realignment of strategies between by some of those larger strategics. One was a divestiture of Plarium from Aristocrat. Aristocrat decided we really want to focus down on the gambling aspect, whether that's real money or virtual. But Plarium just doesn't fit into that, and they decided to sell Plarium, and MTG picked them up for, I think, a great valuation for MTG. And the second one was Miniclip's acquisition of EasyBrain was reported at 1.2 billion. And that's one of the situations where Embracer had bought up all those companies, and they also have a good amount of pressure and the intention to get some more cash. And so that was part of Embracer's strategy to divest some of those assets too. So that probably has been a driver for this year as well.
When it comes to company M&A, is that like some of those deals that you mentioned there, and then you said, I guess, investment and M&A is kind of slowly on the rise again after a long time. But is that actually going to be sustainable, or are these kind of actually one-off kind of deals? So, some of these roll-up companies that have been selling off kind of because they're either moving out of the business, so roll-up, Aristocrats, I guess not roll-up, but Embracer kind of had to sell off. But that's not going to happen again, I guess, until after. So is that sustainable into next year?
So we report both deal value that was announced, as well as the number of deals. And that includes deal where no deal value was included. And that's why when we look at the trend, the number of deals we felt it's a little bit more meaningful. As you mentioned, there's one or two of those deals with a big deal value, and then it comes down again, and that's much harder to predict. I believe the deal value will continue to increase. Number of deals will continue to increase steadily. So I don't think there's going to be a huge spike in Q1. I mean, it would be great if that happens, but looking forward, it's just a couple of factors. More buyers are leaning in, starting to look at M&A again. One factor is also the public company valuations, was flat really until Q2 this year. We came up with this Tradestar index, which looks at the third largest gaming companies traded, and we equally weighed them because otherwise Tencent would take up a lion's share and others don't, but all of those have at least $1 billion valuation. And if you look at how they perform compared to the broader market, they were clearly lagging. And in Q3, for the first time, at least for this year, that index is up 10% for the year. So if somebody had bought essentially same dollar value for all of those 30 shares, they're up at 10%. And believe is the gaming public equity market will hopefully continue to recover. That's an additional driver. A lot of the PE firms looked at what CVC and EQT did, and they are going to buy more. And it's also, if you look at the buyers category, and we can talk about who are the top buyers next year and so on, but another driver is a lot of those PE deals, they typically buy a platform company and then with a goal to resell it or list in a few years at a significant higher valuation. But the key strategy for those private equity firms is do a lot of tuck-in acquisitions, smaller, mid-size acquisitions. And I expect that to happen with CVC and Jagex, as well as with EQT and Keywords. So they're just a few drivers. What's also like on a macro economy, it's everybody is much more bullish on M&A next year. Has to do a little bit with a change of administration here, maybe removing some, regulatory hurdles, maybe making that easier. So there's the sentiment that M&A across all sectors will to some extent bounce back next year. And I think gaming will benefit from that. And then interest rate likely will go further down than further up. And that's maybe also a driver to accelerate that.
If we look back at the significant deals like Playtika, for example, right, acquiring Superplay for $700 million, potentially rising to nearly $2 billion, not look at the numbers because that might muddy it a bit. I'm looking for the common thread. What are acquirers looking for? What are they prioritizing? Are they thinking, as you said before, Michael, might be a platform play that they're looking at? They want to buy something that's going to maybe have stronger live ops, more mileage to it before then, thinking about selling it later on. You have a feeling for that. Is there a common thread of like what makes these acquisitions particularly attractive, or what the acquirers are looking for?
A common thread on most of those kind of venture-backed deals or private companies is kind of first thing is looking at the structure first. It's like a good amount of money at close and then more money later in form of an earn-out. And that's actually a very common structure across almost all gaming deals. If you take some, company divestiture aside, most of them are structured cash at close plus earn-out, and earn-out being based on future performance. So that's kind of a common theme across all of them. Most of the buyers really care about profitability and growth. So, and it's a balance between those two. So a lot of deals trade based on profitability, EBITDA. And then the growth comes in, how is the value at close determined? It's to some extent a mix of what's your current kind of profitability and what the buyer believes the profitability could be, including their synergies, as well as organic growth within their titles over the next few years. So it's kind of profitability now plus synergies plus growth. And that's what everybody's looking for. It's people are looking at increasing profitability.
Profitability means profitable growth, organic growth. You said it yourself. So a bit of a shift.
Yeah, I mean, if you look several years ago, focus was really, for a lot of companies, much more on pure top-line growth and less profitability. It's definitely shifted towards profitability.
I'm actually curious. Mentioned briefly about Rollups. What do you? It's like, especially in Europe, we've had companies like Embracer, I guess, Stillfront, and MTG, which just did a deal. Like, do you believe that or do you think that these strategies kind of have a sustainable future? Because I think when they started, probably talking about stuff I don't know about, so glad we got the expert. But when they started, I think it was kind of unproven if that kind of strategy of just acquiring lots of various different companies that maybe not really related other than being in games, and then companies done that and maybe had some mixed success, to some that to be a bit kind. What do you think is kind of the future of that?
So I think roll-ups will continue to happen. And there's actually several new companies that are really focused on roll-ups. And then it's a difference. Do you call it a roll-up or a strategic acquisitions? A roll-up in the way which Embracer has done it for many years, where they're very fairly fast to shoot, did a lot of deals, and then left those companies totally alone, not doing any integration. That was probably one of the main issues. So I see that happening much less, or maybe not at all anymore. It's when companies are being acquired, a lot of buyers really much focus on the integration. There's maybe sometimes a short earnout period of a year or two where you need to give them an autonomy to do the things within a general framework, but buyers typically also add value. And that's in the Embracer story, was a structure of 7 to 9 year long earnouts, and keeping them alone, not having any common infrastructure. I think that was just that specific issue, and I don't see that happening anymore. But if you look at MTG, I mean, they're working much closer with those companies they're acquiring, and there's several other kind of PE-backed companies, and some of those deals have not been even announced yet. And they're all very much focused on the opportunity of combining some of those assets. Some of them are, let's say, within the mobile space, where some of the smaller to mid-sized mobile companies just having a harder time really getting to scale on a standalone basis. But putting them all together, having much higher volumes, having more users, maybe you can cross-promote them to, it just makes much more sense. But there's also then a common UA strategy and much more integration. So I believe it will continue to be a ton of acquisitions, but probably more strategic. What's important to a different buyer, and certain buyers focus on certain IP. They like companies or studios with their own IP, and sometimes it's a good idea to have a mix of revenue of your own IP, your own games, and maybe have some branded IP games where you work with somebody else, because that helps on the UA side. But different buyers have different strategies, and that's what they're going to pursue for acquisitions. And those broad roll-up what Embracer had, I think that was a specific time in the past, and don't see that happening as much anymore.
Yeah, you mentioned IP. I have a number of colleagues in the industry. That's exactly what they're doing. They're like, yes, we have to build up our value. Our value is in our community. It's in our profitable growth, sustainable growth, a lot of effort made in content, or even we had them on the Pocketgamer.biz podcast before, building up your brand, like Kuaps, for example, wants to be a brand, a real brand. So that's going to make them attractive, and that's going to attract investment, or at least that's part of the strategy. How about the investment scene? We talk about M&A, but some people don't want to sell. They want to build. And for that, they're going to need investment. And we've got private financing, I believe, increasing from Q3 2024. What's it looking like, the current state of gaming investments? I mean, is this the time? Are there like seed, Series A, where it's really active, really hopeful? Because, of course, I think about our audience, it's indie and mid-size wanting to grow in this market.
I would say the financing climate is much more difficult than the M&A climate. So just number of deals. So we counted about 181 deals in Q3. And if you look at the total numbers, like above 200, like 2 years ago, and we slightly came down from Q1, but a very large number of those, I mean, I think we said like 169 of those were really early stage and seed deals. And that's where still there's a lot of activity happening. We were kind of surprised that the blockchain/blockchain gaming space still captured the largest number of investments in this early stage segment compared to others. So I would say on the seed stage and maybe early stage, things are fairly healthy. But in the a little bit later stage, growth stage phase, things are fairly difficult, I would say. And if you look at the investments that happened in Q3 and before, it's very little money going into studios, very little VC money. And that's kind of a challenge for gaming companies that have maybe not launched a next major title yet and still need some additional capital. And they maybe raised some money before, or they maybe just did an early access and need more money to scale up the game. That's a segment where things are still very challenging. And hopefully will get better over the next 2 years or so. But that's one segment that's, I would say, is still pretty tough.
I guess to just follow up on that, like why is it so much tougher for the studios that I guess are looking, or for studios and studios that are looking for growth? Is it, this is a total guess, like is it because of like slow growth generally in the industry, and obviously privacy changes and kind of waiting on regulations? Is that the issue?
That's maybe one issue, but then also just, to some extent, more uncertainty about some titles. Some of the bigger titles didn't perform well, and it's just predictability. And when the market was very frothy, everything was going up and up. Investors were less concerned about the possibility of some titles maybe not performing well. And now with some of the big titles maybe didn't perform well, the whole market has been more challenging. So that's probably one segment. The second on the VC side, so VCs goes to the same cycle, right? They raise a fund. For them to raise a new fund, they need to have a lot of LPs to put in their money, and then they invest in companies, and at some point there's an exit. Exits have been slow the last year and a half, and for some of those venture funds have been very active to raise new meaningful funds. They need to show to the LPs, look, what you invested in the past, it actually worked out. We already got the first amazing exits, and that's where I guess V Games did really well with a Superplay investment. I'm sure for them it's going to be much easier to raise money for the next funds. But for some of the other funds, I guess the LPs are asking, well, I'm not sure if I want to put in more money into your next fund right now. I just want to see more proof points. So that's a whole cycle where more M&A exits will lead to more LP money flowing back into VC funds, and that then coming back to going into the ecosystem. That's one. Another shift that really happened over the last 2 years was Tencent, and to some extent NetEase too, were very, very active. Tencent was a very active acquirer and extremely active investor. And NetEase also was fairly active on at least on the investment side, and a lot of deals were actually not even announced. And both of them scaled back a lot. So often for studios, money came from strategics for growth stage financings, and Biden's obviously with the whole TikTok situation and so on, at least for the US market, kind of totally freezing that too. So there's also less money from strategics or from the biggest investors, let's say 2 years ago. They're very cautious now. Others, to some extent, stepped in. Krafton is very active right now. Just saw today Nazara investing out of India, doing minority investments in several gaming assets. But the those are probably less strategic money going in and VC money just being tighter. And yeah, combination of all of those.
I'm also you mentioned blockchain. I feel like it goes away, it comes back, goes away, comes back. It's kind of the cycle forever for years. It kind of goes through. I guess if you're a company looking for investment, what are the kind of the big buzzwords at the moment? Do you have to mention AI in your pitch deck? I guess is metaverse still a thing? And also, do you is building a game enough? Do you have to be building a platform or building up your tech stack? Like, what's interesting, I guess, to investors at the early stage?
I haven't heard metaverse in a while. There was a good buzzword a while back, and maybe not as popular anymore these days. And yeah, I mean, it really depends. Is it a studio? Is it a content play? Is it a tech play, a platform play? There's a good amount of AI gaming stuff. There's obviously a good amount of blockchain stuff. So it kind of depends on the segment. I mean, from my perspective, using those buzzwords are always good, but depending on the stage of the company, kind of team, I would still rank very high or top kind of if there are accomplished people that have shown exits and maybe even work together as a team, that's still probably the most important for early stage. And then, showing early traction with the title and maybe, you know, possibly being a little bit more frugal to show this early traction versus um, building massive things. I mean, those are probably key items on blockchain specifically. It always comes in cycles, and I personally think with the crypto economy getting a significant uptake, I think Bitcoin, as an example, just hit an all-time high like last week, close to 100K, and a regulation around blockchain and blockchain gaming being adjacent to that, probably going to be reduced, at least in the US. Um, I believe blockchain gaming will have another kind of very exciting, very exciting moments next year where more money is flowing in, and hopefully we're going to see some great games coming out in a blockchain space, or at least other games that implement blockchain elements for some of their virtual goods or something like that. So I'm pretty bullish on the blockchain side for next year.
Interesting one to note, because it was a while there. I remember doing a couple interviews where it's like, we're not even going to use the word anymore. We're going to call it something different because it had such a stigma attached to it. Seriously.
I still see that where companies, they call themselves a blockchain gaming 2 years ago. And now say we're a gaming company and we implement some blockchain elements, but if they do any content, the goal is to do an amazing game, reach a broad audience, and that positioning, yeah, has definitely changed.
Just a follow up, because to the point that Craig made about what's attractive, another thing I've been hearing that's attractive is when you diversify. So you say, oh, let's go into non-gaming sectors. If you think of, for example, Voodoo's acquisition of the social app Be Real, or just companies looking outside themselves. Maybe they're doing cross-platform, they're looking at Steam. I mean, it seems that diversification is exciting, is attractive, or is that just us looking in?
Some of the large gaming companies are looking, for example, at the broader mobile app space. And that's where Voodoo would come in too with a Be Real acquisition. They're looking at, does it need to be a game, or can it be a utility app or any entertainment app, which essentially follows the same model where you need to be very good in user acquisition, acquire the right users, use the internal engine, need to focus on retention, retaining those users, monetizing those users. And we see several acquisitions happening by large gaming companies in those adjacent areas, specifically as the traditional free-to-play games and mobile just got much more harder because it's harder to target the whales that was kind of a big way to monetize, and leveraging the expertise those large gaming companies have built internally with mobile UA and monetization, leveraging that for other segments, definitely going to be a thing for next year.
Yeah, that's really interesting. It's something I've been writing about a fair bit, I feel like now, where games companies kind of diversifying into non-gaming. Like Krafton did it, like short videos back. Not like TikTok style, I mean like short like dramas, like Quibi tried to do, and Krafton like invested heavily into that. So it's quite interesting just how games companies are changing it up. We're nearing the end of the year, and obviously one of the things that we're kind of talking to everyone about is predictions, classic end of year questions. But I guess looking ahead, how do you anticipate kind of a busy 2025 for gaming investments in M&A? What are we going to see next year?
Yeah, so as I mentioned, we predict kind of a steady increase of number of deals over the next few quarters. So not a hockey stick increase, but a steady increase. And we think, companies like Playtika, Take-Two will continue to be active. Very hopeful that we're going to see some major deals from Scopely, which is now owned by Savvy. Then Krafton has been very active. Nazara is one also worth highlighting. It's kind of the largest gaming companies listed in India, and they've been very, very acquisitive. I'm hopeful that we're seeing some more deals from Tencent and NetEase, and Tencent just announced the first deal in a long time from Tencent proper, not like a Supercell or Miniclip deal. So hope they're going to come back. As I mentioned before, Keywords and Jagex are definitely two to watch, as they now have PE backers, and the goal is to further grow. Hasbro just announced that they want to invest over 100 million more in the PC console space. That was very exciting. So hopefully we're going to see a deal, a company being acquired by Hasbro next year. I thought it was interesting that Phil Spencer mentioned Microsoft, while still digesting Activision, Blizzard, which is obviously massive, they're considering acquiring kind of mid-sized mobile gaming companies. I think it needs to be the right fit. I think they're still very, very selective. But if it's, I mean, he didn't mention it. He mentioned it for a reason. Probably to maybe get more deals that are in the market in the mobile space, and they felt probably with Activision Blizzard outside of King in the casual space, very strong in kind of the PC console segments, and maybe a little bit less strong on mobile. So doing some additional acquisitions there seems to make sense. But who knows? It's really hard to say. Another interesting one to watch is also what's going to happen with with Elden Ring, with From Software out of Japan. If Sony will be able to acquire them, or will Kadakawa or something, I think is the name of the company who owns large number of shares. I can't remember the name of the
From Software, but obviously the parent company, I can't remember what it's called.
Yeah, so that's interesting one. But also, as I mentioned before, for gaming studios, I see a good amount of them, kind of some venture-backed companies that are maybe not profitable yet, to settle for an exit. And the exit might be not like a 10 or 100x return for investors, but more like finding the right home, because it's very hard to find additional growth financing. So also see a good amount of deals where, companies join larger ones. It's not a big outcome, but it's a safe home. And if the games perform well over the next few years, there will be additional payments. But I also see a good amount of that. See more PE deals happening, similar to the Jagex and Keywords deal. Further recovery of the listed companies. So we hope we'll be able to report that the Drake Star Index is up a lot middle of next year, but we will see. hopeful that the IPO window will open up again. I mean, we had a fantastic IPO in Korea with ShiftUp, but that was the only really major gaming IPO I can recall in the recent past. But with global M&A picking up, it's predicted that IPO will pick up a lot too. And, Reddit obviously had a fantastic performance since they listed. So hopefully we see some of those gaming companies listing. And then, hopefully some of those exits will lead into more money flowing into the VCs and they reinvest it and seeing continuous growth in the whole ecosystem.
I just wanted to pick up on one thing you said there, which was companies kind of finding like a home rather than like a 10x or 100x exit. Is that like, this is a harsh way to put it, but is that like kind of giving up on that company? If you're just finding it, if companies just going to find them if investors just going to try and help them find a home, and then they're going to look elsewhere to actually put their investments.
I wouldn't necessarily saying it giving up. It's just finding the best possible outcome considering the situation. If they can raise more money, it's maybe investors just get their money back, and there's not a big return. It's finding the right home for the team and the people, and they continue to realize their vision, what they want. And then maybe if some of those titles perform well, there's actually might be a really good return for investors. But it's just practically, if it's very hard to raise additional money, company can decide to shut down and everybody gets nothing, or you join a company, you get some value out of it, you keep the team together and work on your dream, making the titles and the games great.
If there's one piece of actual advice that you could give studios navigating this kind of evolving investment landscape, what would it be?
I think it's very important for the CEOs or the founders to be aware what's happening in the ecosystem. And that's just following what's happening on the financing on the M&A side, kind of staying up to date what's happening, and getting to know some of the investors if they're looking at the financing or some of those buyers, just so to become a little bit more of a known entity. That's either having some informal meetings at conferences or getting to know, some of the VCs, depending what they are. And also considering for studios kind of publishing deals, kind of generally keeping your options open and being spending a little bit more time on getting to know the right players within the overall ecosystem. I think some founders are so heads down, only focusing on their product, which makes sense. But as a CEO or founder, I think one role is also kind of building up the relationships to potential investors or buyers. I mean, I get asked all the time for startups what investors should we contact, for example. And in our quarterly reports, you might have seen we put together those league tables, larger gaming VCs, seed stage gaming VCs, strategic investors, and crypto investors. First question I always ask is, did you look at the league tables? Those are the guys who invested in most companies. So if I were you, I would at least pick the top 5, talk to the top 5, whatever, if you're doing a seed stage deal or a VC deal. Have you talked to the office ones? And often they say, oh, actually, no, we don't even know anybody there or anything. And the same also on the M&A side. Who are the guys who are the most active? Getting to know them a little bit. That's probably what I would do. I try to post a lot of kind of news updates on LinkedIn as soon as I find out about it. So that might be one to look at more real-time stuff, but generally be aware of the ecosystem and try to stay as flexible as possible. If you're raising some money, maybe also considering a sale and the other way around, and just keeping your options open.
And you said that's in your latest report. So didn't look at the lead table. I'm not thinking about getting funding, but is it there for deeper analysis? Do we see these names there in the report? So our audience, we can give it to them in the show notes. Absolutely, they can check it out, correct?
Yeah, we've been putting that in for the last years, every quarter, and it's like we always look at the last 12 months, like, and also clarify, we only add announced deals. Some investors said like, oh, we actually did much more deals, and we said from a methodology point of view, we kind of summarize what has been announced, and if some deals have been not announced, we're just don't feel it's appropriate to include them. And some companies might not even want to have them announced until they feel they want to announce it. But it's definitely, we have them. We have 4 league tables in the last report. Again, one is large gaming focused VCs. Second league table is the seed stage VCs for games. One is focused on crypto gaming, and the last one is a strategic. What are the largest strategics that participated in minority investments over the last 12 months? And like Krafton has been very active on the strategic. Sony, Animoca very active on a strategic side for blockchain. Even Square Unix was active on the strategic minority side. And on blockchain, Spartan has been the most active blockchain VC, followed by Big Brain Holdings. And then on the early stage, the Game Fund reported 10 early stage deals, One Up about 8, Gem Capital 8, and a lot of other early stage VCs. So definitely worth getting to know those folks and maybe giving them some updates.
And great timing for it, because you say to yourself, okay, my resolution for 2025, follow everything Michael Metzger writes or shares, and then hit up everyone on the list. Well, not hit them up, but get to know everyone on the list, hopefully at upcoming PGC events as well. PGC London right around the corner. Who knows who we have there? You know who we have there, Craig. Are we having a good representation of investors there as well?
Yeah, always. And Michael, I don't know if you're already on the list, but you're always welcome at the show. We're doing the usual investment panels and sessions.
Excellent.
Be a packed show.
Well, we got a lot of action items. We got a lot of insights as well. I think this has been a great show. And Craig, it was your idea. Perfect timing, because this is the way to leave people with actionable insights, action items, get things going, start gearing up now to hit the ground running in Q1. So thank you both.
Thank you so much.
This show is all about how to do your job better, how to make an amazing game, how to market it, and you have a say. So if you have a story or know someone we need to shine a light on, then we would love to hear from you.
We want to hear from you. We want to reflect the reality of the mobile games market in all its wonderful complexity and strangeness. So if you have any suggestions for us, if you have any feedback for us, you can always get in touch. You can email us at podcast@Pocketgamer.biz. You can find us on Twitter @PGBiz, and you can reach out to us through the Pocketgamer.biz website. If you're interested in listening to all of our podcasts, you can find them at pocketgamer.biz/podcast, and we would love to hear your thoughts on future shows.
And we've got you covered on all the major platforms, so subscribe to the audio podcast, as Brian said. Look for us on YouTube. If you want to read it, hey, you can do that too, because we have a companion post for you as well on the Pocketgamer.biz website.
Tune in again for the next edition of the Pocketgamer.biz podcast, and we look forward to speaking to you in the near future.